Welcome back to the Chiro Money Show, where we're helping chiropractors make better financial decisions so they can build stability in their finances and a lifestyle that they love. We're your hosts, Chris Shield and Scott Campbell, financial planners with Align Well.
Chris, I couldn't help but notice right away. I know our AI audio stabilizers will do the trick for us here, but your room sounds very echoey. You have nothing in the room anymore. If you're watching on YouTube, there's nothing on the blue wall anymore behind Chris. The move is happening. The move is in the horizon.
Getting real. Yeah.
But the blue wall's there. And you're going to leave the blue wall behind to the new buyers.
Yeah. Maybe they'll join the team. Who knows?
I hope they don't paint over the blue wall. I hope they call it the blue room and bring it into their home and
I hope
someone
so.
embraces it. Yeah.
I hope so.
I hope so too.
I don't know how quickly I'll get around to painting the new blue wall in my new office, but we'll see.
I still got at least a half gallon of blue paint, so
yeah, I don't know if we have room for that in the move. She's tight.
We'll see.
We're currently playing Tetris, packing everything we can into our moving container.
All right.
So life is full on right now, and things are half packed.
That's right. Yeah.
Soon enough, we'll be in BC.
Yep. Mm-hmm. Well, all the best here on the upcoming move. As far as the topic today, what are we chatting about today, Chris?
One of our favorite topics. I won't say it's picking on accountants, but kind of.
We're not picking on anyone here. We don't. No.
Fine. We're not picking on anyone, but
a fun topic of ongoing discussion with clients along with their accountants.
Yes,
and that is write-offs.
Yeah,
what you can write off as a business expense. We've seen it all. I know I've seen it all.
Yeah,
it's a funny and interesting topic. Before we dive in, I actually have a really great clip from YouTube that you can listen in on if you're listening. Enjoy if you're on the YouTube. I'll play a quick clip here. What clip do you think I'm going to play?
Schitt's Creek.
I knew you were going to say that, and that's because you're not as old school as me. I'm actually going to bring in a clip from my favorite show of all time here. So hold up.
Seinfeld.
You got some Seinfeld.
Yes.
So we're going to make the post office pay for my new stereo now? It's a write-off for them. How is it a write-off? They just write it off. Write it off what? Jerry, all these big companies, they write off everything. You don't even know what a write-off is. Do you? No, I don't. But they do. And they're the ones writing it off. I wish I had the last 20 seconds of my life back.
So good. That never gets old.
Yeah, I love the Schitt's Creek clip as well, but I had to go old school Seinfeld for that one.
That's a classic, man. I could watch that over and over.
Mm-hmm. It's true.
I
think a lot of our clients don't truly. I'm saying that tongue in cheek, what a true write-off is. I think there's a common misconception that once you set up a corporation that you are automatically kind of in this kind of new territory of a methodology of being able to gamify the system and create some further tax efficiencies, deductions, and to some degree there's opportunities to optimize, but in a lot of ways there's also a lot of people who are putting expenses through their business on a regular basis that they're just an audit away from basically just getting themselves into a big headache of an issue with the CRA, getting an audit, proving these expenses, making sure that they were legit expenses. And in some cases, if they were not, then they have to pay back taxes along with interest, and it turns into a big mess, right?
Yep. Yeah, I totally agree. I think the non-business owner community, or before, as people become business owners, they believe that there's going to be all these advantages. And while that is true in some senses, it's really there's not that much difference. Sure, there are some opportunities for legitimate things, but at the end of the day, you can't just put everything through your business all year long.
Mm-hmm.
And you can't just do that. What's going to happen is at the end of the tax season, your accountant's essentially going to reassign or assign some of those expenses as personal benefits.
Yep.
And it's going to be attributed back to you in the form of a surprise tax bill.
Yep. We'll touch on that. We'll touch on a story of the downside of that kind of approach, especially on the high end. But before we get into that, let's first talk about what an actual expense is. Like what would be considered like maybe the CRA's test when it comes to actually making someone from a high level, what is a deductible expense that you can run through your business?
Really anything that was incurred in the process of you earning business income. Was it required for you to earn an income? If it was not required or like necessary, it's likely not totally covered as a business expense.
For sure.
And then secondly, is the amount reasonable? So you can't say that like, you know, one good example is like, you know, I need to buy a pen to do my, sure, I need a pen on my desk to do my job. Fair.
Yeah.
But I don't need $100,000 pen.
Right.
I need a $1 pen. Like, is
I'd
that
love to see a
reasonable?
$100,000 pen though. Show me
Man,
what that looks like.
Yeah,
I'm sure they're out there.
I'm sure they are.
Yeah, for sure. Yeah, the point here in terms of like the gut check that one could make in terms of wondering if you're maybe potentially crossing a line with running an expense through your business, like if it makes you squirm a bit having to potentially be in the hot seat trying to explain it to an auditor, then you probably know what the answer is going to be from said auditor and the CRA in terms of their opinion on that expense or how much of one type of expense you're trying to put through your business on an annual basis.
Yeah.
So let's talk about maybe some of the most common things. We won't get into everything, but maybe some of the more common conversations that we're having with our clients, and again, in some ways, collaborating and talking to their CPAs about like what they should be doing from a tax deductibility standpoint. Let's talk about vehicles first, Chris. What's the most common thing that we kind of have questions on from clients, and we're having ongoing conversations about should I do this and why or why not?
Yeah, I think the first one is like, can my corp own my vehicle or lease my vehicle? And like, obviously, isn't that a good thing? If like my corp, I pay for my vehicle with pre-personal tax dollars, and yeah, I can see how that, feels good. But at the end of the day, if the vehicle is not primarily being used to earn business income, i.e., if you have a clinic that you work at, there's not really a lot of vehicle expenses that are going to be covered in that, right? You can't claim your commute from your home to your main place of work. Now, if you have 2 or 3 clinics and there's quite a distance between them and you're traveling between them frequently, yeah, okay, now we're getting into some legitimate things where you need to travel to a different clinic in order to earn an income. Sure.
That's right. Yeah.
But yeah, that's probably the most common one is like, I just want my corp to own it and pay for it because that's easier. It doesn't mess up my personal cash flow plan.
That's right. Yeah. Yeah. There's obviously a time and place for when it makes sense. Like if you were, say, one of those chiropractors who had like a mobile office and you went around to people's homes doing your adjustments and delivering care, then absolutely you could probably write off the majority of your vehicle expenses through your corporation. But for, I would say 95% of the chiropractors out there who are driving to their place of work and then driving back, there's really very little reason to have any sort of vehicle expenses running through your business. That said, like if I'm just an example here, like if you were, say, living where we live in Edmonton and you were going to, say, a conference in Calgary and you wanted to you're going to drive down the highway and, rent a hotel room and go to a conference, you could write off the mileage from Edmonton to Calgary for that business trip. That's totally acceptable, right? And that's where you get essentially a rate per kilometer that's essentially attributed back as an expense to the business, and then the business essentially owes you that back personally. But what we see all too often is we have someone who puts all their vehicle expenses, through the business, maybe their vehicle payment, their auto insurance, all their gas purchases,
Maintenance.
and maintenance as well. And in some cases, some of that would be deductible. But like you were saying earlier, and we're going to get into an extreme example of this later on in the conversation, but you might feel like, all right, I'm putting it all through the business, and maybe you're aware of it, maybe you're not. But in a lot of cases, your accountant is going to then, if they're doing their job properly anyways, they're going to be asking you for some sort of mileage log to understand what you did in total business business mileage versus personal. And then whatever was personal use, like you said, Chris, it's basically all wrapped up again and then attributed back to you in the form of income, which you then pay taxes on. And usually that's distributed back to you in the form of a dividend. In a lot of cases, you weren't planning for the extra tax owing on said dividend amount being attributed to you. And then you get into this like messy tax cycle, which we've talked about in the past with kind of random draws from the corporation. This is almost kind of like a random draw. Like you don't really see it in the moment, but it's going to be attributed back to you as a random draw at the end of the year. Boom, added to your tax return, extra tax bill to pay.
Yeah.
Right. You're no further ahead. At the end of the day, you're no further ahead. That's kind of the point here.
No, exactly. And in our opinion, the much more advantageous way to go is like, okay, if you use your vehicle for business use 5% of the time, well then claim your mileage on that and get reimbursed for that and get like that tax bonus at the year end where the corp owes you money tax free.
That's right.
That's a way better place to be than having your business own the vehicle, but 95% of that ownership cost and maintenance and ongoing cost being attributed back to you in the form of compensation or personal benefit at the end of the year.
Mm-hmm. I think there's a very similar touch point on home office expenses as well. Again, it's going to be variant depending on your accountant and their comfortability with how much home office expenses they would kind of deemed to be acceptable to run through the business. But say you could prove that you do a fair bit of, say, maybe do your notes and any sort of business work all from your home office, call it that. At that point, then you can legit take a certain portion of your square footage of your home and a certain portion of your your home insurance, maybe your alarm system, a portion of your internet, but you can't just be like, oh, because I'm doing a bit of my notes at home, I'm going to run my full home internet bill through the business. Doesn't work like that, unfortunately. Like it would be a portion of that. Whether you're aware of it, whether you're not, that's what's up for debate here.
Yeah. And like we've already said previously, in a lot of these cases, even if your accountant is allowing you to put that expense through, it's not usually claimed as a full business deduction.
That's right.
It's usually a proportion, like a percentage of it that is a legitimate business deduction that is attributed to you earning income.
Yeah. And one caveat here before we move on, like one thing that's important to mention too, like this all also hinges on how detailed and thorough your accountant is, right? At the end of the day, it's not always the accountant that's on the hook if there is an audit for what they're putting through the business. Like at the end of the day, the buck stops with the business owner. Like if you're putting, say, your home internet through your business in full, but really in theory, it should have only been a portion of that being deducted as an expense, and then you get audited, that's not on your accountant. Like maybe you can go after your accountant for some of that, but at the end of the day, it's gonna be on the business owner at the end of the day. So you can't just always trust that your accountants, you have to make sure you have the right professionals in your corner doing the good work too.
Mm-hmm. For sure. Should we go on to some other gray areas? We've already talked vehicle and home office. Those are pretty common.
Yep.
I think maybe before we move on, we should mention like there are some docs that, work out of their home. And if you have a home-based clinic where you're treating patients from your home, that's completely different. That opens up a lot of opportunity for further deductions because that is your main place of business.
Mm-hmm. At the end of the day, it'd still only be a portion of your home. Like it's going to still be a square footage. Maybe you can get away with putting more of your, say, internet or some things like that through your business, but it's still going to be a portion because you still have a lot of your home being used for personal use, not just for business. All right, should we talk about the next fun area that we see a lot of when we open up that transaction history on a QuickBooks Online? We see a lot of meals and entertainment, a lot of transactions going through there. I think there's oftentimes a lot of confusion about what that is in terms of an expense and an eligible expense. So first and foremost, if you weren't aware of it, when it comes to meals and entertainment being run through the business as an expense, only 50% of any sort of meals and entertainment expenses, like going out to a restaurant, for example, only 50% of that expense is going to be a deductible expense to the business. Okay. I think the reason for that is like part of it, I think they may be saying like half of that's going to be for the business owner, like a benefit to the business owner, and half of it's going to be for generating, for the sake of ideally trying to generate business. I think the biggest kind of issue I see in this area when I'm reviewing someone's QuickBooks and looking at all the expenses is that maybe the amount is maybe call it reasonable, but the sheer number of transactions that I see going through some of these ledgers in terms of meals and entertainment, the worry that I have for a lot of my clients is like, you might get away with running this through because it's a reasonable amount in total. But if you don't have the documentation of every single receipt saying, hey, I went out for a meal with XYZ client to generate business, that's hard to prove. Like, there's obviously some unique things that you could do. Like, say you're in business with your spouse and they're your office manager, you could probably get away with putting some more meals through the business and talking about business at meals. Maybe you're treating out your staff. That's a whole different category in terms of staff kind of meals and entertainment as well. So it's just an area to be mindful of. When I open that up for a year and there's 120 transactions, lots of skip the dishes, lots of meals and entertainment kind of going through there, I just question whether or not, if you get audited, if you actually have the paper trails to legit show that these were all fair expenses. Would you agree?
Yep. Yeah, absolutely. I think it's interesting there, the exception for like staff events. That's like you mentioned, that's kind of different, right? Like there's two distinct areas here. It's like business, like meals and entertainment for the purpose of generating business, i.e. you're taking out clients, you're networking, etc. That is covered at 50%. Then there's the exception for staff events. If they're open to all staff, then you can get 100% exception or deduction on those events, which is, I think that's great, right? It's like allows employers to treat their staff and not be kind of penalized for that. Like being able to fully write that off is like incentivizing us to, in a way, to treat our people well.
For sure. And it all makes perfect sense. If you have a nice team of staff and you want to take them all out for a nice meal or even beyond that, like go do some sort of fun activity, it makes sense because you are doing that is a legit expense. You're doing some team building that's helping support the business to grow revenue. Like it all makes sense when you really think about it from a big picture standpoint.
Yeah.
Right.
Yeah.
Should we talk about golf?
Man.
Let's talk about golf. We got some golfers in our roster of clients that probably hate these rules or try and push it to the limits.
Yeah. Yeah. Golf is a big one. And ultimately the CRA is very, very clear. They hate golf. Period. Full stop. They hate it.
No one in the CRA is on the PGA Tour, hey?
No. I mean, maybe they're fans of the game. Maybe they're like...
Maybe not. No, Chris, they hate it. They won't watch that sport.
Yeah. No golf for us if you're a CRA person. But yeah, basically they explicitly state that green fees for golf are not deductible, full stop. Like, doesn't matter what kind of business you are doing on the course, who you're golfing with, green fees are not deductible, period.
Yep. Or a full country club membership, golf membership, you name it, all the above, right?
Yeah, exactly. And that goes for any club, any membership where you have purpose. The main purpose is recreation or dining. So there's a lot of, memberships, clubs out there where, that's the purpose. It's like it's a social club.
Right.
Really.
Doesn't have to just be golf.
No, it can be any number of, activities.
Yeah. Pickleball. Yeah.
Yep.
I'm sure that's growing.
Yeah. Those fees for those annual memberships are not deductible.
We haven't had anyone try to deduct like a pickleball membership quite yet, but I'm sure it's on the horizon.
Yeah. Growing sport.
Yeah, for sure.
Yeah.
But when you finish up your game of golf though, Chris, what could you potentially deduct?
Yeah.
As like let's make our golf listeners feel a little bit better.
Okay. Sorry. Yeah. The one kind of positive you can take away if you're going golfing, if you stop for a meal in the clubhouse after golf.
What's your meal? Wait. What's your go-to meal after a round of golf?
Clubhouse for sure, man.
A nice clubhouse.
Yeah.
Pint of lager.
A clubhouse in the clubhouse.
Okay.
If you do that and there is real business purpose and an itemized receipt separate of green fees, then it applies, back to the same meals and entertainment.
That's
where
right.
50% of that is deductible.
Hey, it's Scott here with a quick addition to today's episode. After the recording today, Chris and I were just wrapping up and realized we talked a lot about what you can deduct. We talked about how only 50% of meals and entertainment are deductible, 100% of green fees are not deductible, but we never answered the obvious kind of follow-up question of, okay, so what actually happens to that money then? So here's the thing. Non-deductible does not mean your business can't pay for it. Those are two different concepts. And this is where a lot of confusion comes from. So I'd like to take you through a real example. So let's start with meals and entertainment. You take a referral partner out for dinner and the bill is say $200 on your corporate credit card. The full $200 comes out of your business bank account and the full $200 shows up as a meals and entertainment expense on your books. Nothing strange there. What happens is there's an adjustment at tax time. So when your accountant prepares your corporate return, there's a schedule where they essentially reconcile your total income versus your taxable income. And one of the standard adjustments is what's referred to as an add back, adding back 50% of meals and entertainment. So say for that $200 expense, $100 or 50% of that meal gets added back to your income for tax purposes. So the technical term is an add back, and it's what's called a permanent difference. So that $100 never gets deducted as an expense this year or any year. What it means in dollars is, say you live in Alberta and you're paying the Alberta small business tax rate of 11%. Rather than it being 100% deductible, $100 of that meal or 50%, you're going to be paying about an extra $11 in extra corporate tax. That's it. So same kind of thing works with golf. Golf works the same way, except it's at 100%. So you could take a client out, put the green fees on the corporate credit card. Again, this is totally fine. Again, has to be for the purposes of generating income, a business expense. So as long as there's a real business purpose, the full amount of that green fees is going to be put on the credit card. But in the case of golf, the full amount gets added back at tax time. So you don't get any deduction, but you're still funding that round of golf with corporate dollars where you're paying a lower corporate tax rate than if you were paying for with personal dollars, paying maybe a tax rate of 35 or 45% plus. So there is a significant tax savings there in terms of putting that expense through the corporation. But the catch here is that it's still, like in the case of golf, for example, is that it still only works if it's a genuine expense. Taking a referral partner or a potential associate out golfing, that's going to be an add back. No problem. You're going to pay that lower corporate tax rate than on the personal side. But if you just love golf and want to run your personal golf expenses through the corporation, that's where your accountant is going to do what we were discussing in this episode in terms of adding that back as a shareholder benefit, gets attributed back to you where you're going to pay personal income on that. So hopefully that clears up any sort of confusion. If you were wondering of like what happens to that extra 50% that's not be deducted if I'm putting the whole, say, restaurant bill through on the business credit card, hopefully that clears things up. So, all right, that's it. That's all I had to say. Let's carry on with the last little bit of today's episode. Yep. At the end of the day, we're not trying to be Debbie Downers here. We're just stating the facts. At the end of the day, I wouldn't say Chris and I are conservative when it comes to tax write-offs through the business. We're just realistic in terms of what the CRA says is a write-off or not. You obviously have to end up working with an accountant that you align with. And there's obviously varying degrees of accountants of like very conservative versus those that really push the limits. And we're not saying that one is better than the other. It's finding an accountant that you want to work well with. But understand that at the end of the day, just because you have put it onto a business card, and even if it's been put onto your return as an expense, that doesn't mean it's all said and done. Like there is a number of years, I think it's 7 years that the CRA can open up your file and say, hey, we want to do an audit. There's also different varying levels of an audit as well. Like there's an audit, like a full-on audit of your full return. And they also might do these spot audits where I know I've had a spot audit a couple of years ago on a certain category, like one particular area of like, I don't think it was meals and entertainment for me. It was something similar though, of like, show us all of these receipts, especially these larger transactions. Can you prove that these were all expenses? That can happen to anyone. They can be like, hey, this year we're gonna pick on professional corporations, and we're gonna pick on this particular category of an expense. Let's have at it, right? You just don't want that headache. It's not worth the small amount of like tax savings to go through that stress. And then potentially the back tax and interest that comes along with that.
Yeah.
It's just not worth it.
I think, yeah, just to kind of summarize this whole topic, this whole idea, it's like the juice is not worth the squeeze. Like you're not going to change your financial life by optimizing a couple more write-offs or taking a little bit more risk in how loosely you play with the CRA rules. Like that's
Yeah.
not moving the needle.
Yeah.
Period. Like
So true.
get it dialed in, get your systems in place for how you manage your expenses and how you connect with your accountant. But there's much bigger fish to fry here. Like let's focus on what really matters, what's in your control. Because the CRA rules, they're not in your control.
That's right. Speaking of loosely, Chris, like let's talk about a client story that to wrap up this conversation about the extreme end of how, some like a client story that resonated with us because it just was, again, the juice was not worth the squeeze. Essentially, this accountant told their client or a mutual client at the time saying, hey, we want you to essentially, if you think it's a business expense or in that category, basically run as much through the business as you want as an expense. So we saw everything. We saw kids swimming lessons all the way to like a ton of meals and entertainment to home decor, travel, like you name it. The list went on and on and on in terms of like tens of thousands of dollars being run through the business as an expense, with the client being like, I'm not exactly sure, but my accountant told me just to kind of put it all through the business and then they would sort it out at the end of the year in terms of like going through those transactions and taking a portion of it, making sure that it's reasonable, in air quotes, reasonable, and running that through as an expense. Like you said earlier, to kind of kick off the conversation, the downside of that is that the larger majority of those tens of thousands of dollars of transactions that were running through the business were not eligible expenses, and to the accountants, like the accountant was probably doing a good job in terms of looking at through those transactions and making decisions on like this is amount, this is what can be put through, this is what can't be put through. But a lot of it, the majority, was saying, nope, this is not going to be an actual expense, and we're going to attribute it back to you in the form of income, in the form of a dividend, and that increased that individual's tax bill, which they weren't prepared for said increased tax bill. And it just turns into this vicious cycle. We're like, well, where did this extra tax bill come from? Well, you had $20,000 of expenses that were run through the business that got reattributed to you back as personal income. It's not worth it. It's just not worth that extra stress.
No. And I'm not sure if this was the case or not, but I've heard of people using some like rough guidelines and like percentages even of like, when it comes to home office or vehicle usage or meals and entertainment, it's like, okay, well, if that is X percentage of your gross revenue, the CRA is not likely to investigate. And I think that's kind of where maybe this could have started from, is like, the CPA is looking at the client's total revenue, and it was like a pretty high volume practice and, good, really, really great business. And so they're like looking at kind of the guidelines and saying, well, hey, we should try to get more expenses through, because like you guys don't have that much of expenses. Because, in this case, it was actually an associate that, didn't have a huge rent expense, no employees.
Overhead small.
Yeah.
Overhead's not very big.
Yeah, overhead's small.
Yeah.
So it's like, well, let's try to get as much as we can. But again, it just caused this tax trap, this cycle of like this recurring tax bill of, these expenses that are being reattributed.
Yeah.
And it was a mess.
Yeah.
And the client was not even aware of it. In their mind, it was my accountant says I can put more through the business.
That's all they hear. That's all they hear.
That's what they heard. They were unaware that 80% of those expenses they put through the business were being attributed back to them personally at the end of the year.
Yeah. At the end of the day, we're not trying to be Debbie Downers or like ultra conservative on this perspective, but like I know from my take, I think it's just, it keeps your life easier if you keep business and personal. And if you do have, say, home office expenses or some mileage or even some things that you're like, I think I pay for this personally, but I think this potentially could be considered a business expense. Pay for it all personally and then bring it to your accountant and say, hey, I did XYZ. Here's the expense. I think it could potentially be a business expense. If it is, then the business owes you that money versus it being added to your tax return in the form of additional income. And now you have like essentially a bonus that the corp then can pay you out this tax-free benefit to you because they owe you, right? So much cleaner, so much more organized.
Much cleaner. Yeah.
Yeah.
Yep. So to wrap it up, at the end of the day, what we need to think of when we're spending as a business, the test or like the kind of in our mind, was this expense incurred in order to earn income? is it reasonable in the amount? And can we prove it? Can we keep that history, that transaction receipt, and prove that? Your life is going to be so much easier if you, like Scott said, keep it clean. Business is business, personal is personal. Run the right expenses through the right cards. And at the end of the year, no surprises, right? We have enough on our plates to deal with as practice owners or business owners. Like, you don't need extra stress come tax time. And this right here is one of these things that can save you from that extra headache.
Cool. Well said. Should we wrap it up there, Chris? Anything else to add? Okay. Well, thanks again for listening in. Hope you all enjoy the rest of your summer about midway through. It's going by fast, so enjoy, and we'll see you all again next week. Thank you.
See you next week.
All opinions expressed on the Chiro Money Show are for educational, informational, and entertainment purposes only. Nothing on this podcast should be considered financial, legal, accounting, or tax advice. Always consult your own team of licensed professionals before making decisions about your finances.